Hello and welcome to the Mutual Fund Show. My name is Niraj Shah. And over the next 20-25 minutes, we'll talk about a couple of things that are top of the mind right now. Um, so both our guests have been on the show a couple of times in the past. Actually, Gaurav has been with us a couple of times. Prableen, Bajpai, who's the other guest, has been with us once before. And I think we're trying to talk about an analytical topic and a behavioral topic, if you will. That's how I would try to classify today's show. The analytical topic is how people go about chasing what's happened in the near past and how it might be akin to throwing a dart if I'm not getting Gaurav's analogy wrong. So that is part one. Part two is the kind of inflow of funds that are happening into international funds, the kind of money that is moving into international funds. And I hear a lot of people argue both sides that you're probably too late because the party's been on for a really long time. And are you entering late? But the other way to look at it is that people who are investing into international funds are not necessarily investing it from a trade or a fund perspective. Maybe even if the party is on for a long time, if you invest it for a sizably long period of time, it's a great diversification tool. So that's the kind of question that I'm going to pose to both of our experts. And let me start off with the first topic, which is it a good idea to buy into the best performing funds? Gaurav, Prableen, thank you so much, both of you, for joining in. And Gaurav, I want to start off with you on this one. There are some very interesting data points, but why don't you take this off? Is it a good idea to buy into the best performing funds? The normal argument is that maybe it is not, but you have some very interesting data too.
Thanks, Neeraj, for having me here. And you're absolutely right. I think one of the things that most investors look at when selecting a mutual fund, and also a stock or a PMS, by the way, this is not just restricted to mutual funds, is they look at past returns. And somehow we think that a fund that is consistent, a fund that has done well in the past, there is somehow some information content there which will help us kind of make more money in the future. Like it's rightly said, money is always made in the future. The past is just the data points you have that you can use to get whatever insight you can. So we did this study where we went to Amphi. Amphi is a treasure trove of data. We downloaded returns of all the mutual funds going back till 2003. So 2003 till 2020. That's our data set. And the way we set up this study was we said, okay, let's look at 1 year, look at all the funds and their performances, and find the top decile funds. Top decile funds means funds that have the performance in the best 10%. Right? Why 10%? It's just, I mean, you have to use some measure. So 10% is a measure, and that's why we use that. So effectively, we are saying, okay, these are the best performing funds based on a 1 year look back. And that's when the fund starts. Then what we do is then we look at the next year returns. And then we say, okay, how did these funds do just 1 year after being in the top decile of the best performing funds for that year, right? So intuitively, you would think that, hey, you know what, there's something good about these funds. That's why they did well. So maybe it will continue. That's what's called persistence in returns, is what it's theoretically called. What we find is, and what a lot of other people have found in mutual funds, in stocks, in PMS, that there's actually no persistence. In fact, if you look at the data, some of the data that I shared with you, if you look at this 1 year setup, right? So the best performing funds in 1 year, how do they perform 1 year down the line? Only 13% of those funds remain best performing funds or remain in the top decile. But what's more surprising, you're on mute, Neeraj. Sorry.
Yeah. No, let me just get this straight so that our viewers understand this. And then we'll come to what is the more surprising piece. So you are saying that all the funds that have done well over the past 1 year, you've broken them into the top deciles, and the top 10% of the funds are taken for the study. And please correct me if I'm wrong, of course. And from that set of funds, only 13% of those best performing funds ended up outperforming the next year, or doing better, or being in the top decile.
Ended up being in the top decile of the best performing funds next year as well. But what's more interesting is 19% of the best performing funds, right? So they were in the top decile, are now in the worst decile 1 year down.
Wow. Okay.
90, right? So I mean, if you don't want to break it down in numbers, because I think that makes it very easy, right? So there are 1,000 funds. We pick the 100 best performing funds. Then we hold them for 1 more year. in the next year, out of those 100 funds, 13 funds still remain in the best performing funds. 19 now have become the worst 100 performing funds in the set.
Wow.
And on average, only 52% of the best performing funds do better than average. Only 52%. It's a coin toss. I mean, the data we have looked at 1 year, we have looked at 3 years. We got questions saying, hey, why don't you look at consistent performance or look at 5-year time horizon? We said, sure, we looked at 5 years, the data doesn't change. The implication doesn't change.
Interesting. So you are essentially, and then I'll get in probably in this discussion as well, Gaurav, but you are essentially debunking a whole halo around funds putting out their performance metrics and people looking at their performance metric and saying that, hey, this fund has done so well for 3 years, maybe they're doing something right. Let me go out and park a large share of my money there. There is no guarantee that that fund will do well. It's counterintuitive, but it seems to be true.
Yeah, I mean, there's no guarantee. I mean, the data doesn't show any persistence of past returns. So you're absolutely right there.
Wow. Okay, before I ask you a follow-up, probably you want to come in on this because you would have been advising your clients and on various media platforms as well about funds which are doing well, and normal instinct would tell that if something is doing well, it is doing well for a reason, and it probably makes sense to side with that. But the data is really interesting.
Right, Niraj, thanks for having me on this show. So, I'll just take this. So, of course, what, Gaurav has mentioned is absolutely true. And this is something that is why we have the disclaimer on all the investment documents that past returns, are not an indicator of what will happen in the future. So we all read it, but probably superficially because somewhere deep down we find comfort in, picking a scheme or an asset class for that matter where we've seen good positive returns. So Gaurav has said, this is true. And the same thing actually has been given up by some few other studies as well. There was a study by the chief economist of the Federal Reserve Bank of St. Louis, and he compared the buy and hold strategy in equity mutual funds with he called it the chasing returns strategy, where he said that those investors who were chasing returns were actually losing about 2% each year. And the outperformance of the buy and hold was was about 5% more overall during the time period 2002 to 2012. Likewise, this also brings up to another further point that investors often say that we haven't made money. So the schemes show returns, and investors often tend to make lesser returns than what the schemes actually show on their fact sheets. Because somewhere as investors, you and me, I think we like to, pick a top performer. We are not happy. We are sensitive to any fund underperforming or not performing that well. And then we tend to somewhere, shift and get on to another best performer. And in the whole process, we end up losing a lot of our returns. And this again has been cited out by an Access Mutual Fund study, which read, the data from 2003 to 2015, where equity mutual funds gave about 22%, but investors only made about 15% CAGR. And likewise, a Motilal Oswal report, which says from 2002 to 2020, the difference between the returns that investors actually ended up making was lesser by the category returns they had taken a large cap fund. The difference was 15x, which is really high. So it is also about if these funds are not giving consistent performance, and it is also a lot to do with to these, let's say, phases of underperformance, or somewhere the luck to kind of stick to a top performer.
Yeah, and maybe viewers, I don't think there's an exact science to this, but I think maybe there is merit at times when people say that if you're buying something and holding on to it, ride it if you have conviction there. But clearly the starting point is the key point out here, viewers. And I think a lot of us do that. We go to any website. You go to any website which has mutual fund data, and then you tend to sort by the funds which have given the best returns in the last 1 year, 3 years. And if that number is high, instinctively, you go out and buy that. And I think this study shows that this is not true. Now, Gaurav, my follow-up question to you is, I heard you mention that people asked you that why are you looking at only 1 year? So look at a slightly longer time frame as well. Are you saying that even slightly longer time frames, these results stand true, maybe not to the exact decimal, but somewhere around that?
See, we went and then we did a 3-year study where we said, okay, we'll look at the best performer over the past 3 years. We will look at the best performers over the past 5 years. We will look at the best performers over the past 5 years where the returns are consistent, so there is no one outlier here. And none of it actually merits a deeper dive. None of it shows that, okay, you know what, yeah, this is something, this is a setup that kind of predicts future returns, because it does not. Effectively, I think what Prableen is saying is very, very true. And there's a word for it also. It's called the behavior gap. Behavior gap is literally the amount of money that investors leave on the table because they're always chasing a best performing fund. And so they're always, effectively what happens is you're buying high, selling low. You go in, you buy a best performing fund. Not all of the funds will do well, right? In our study, it's only 13% who continue to do well, or 48% who continue to do well. So there is a 52% chance that your fund will actually underperform the average. Then you will be brokenhearted. You'll be like, wow, I bought this because, you know, it was giving 30% returns for the last 3 years, and now it only gave me 5% returns. This is a bad fund now. And people talk in those terms. It becomes a bad fund just because the returns are bad. It becomes a good fund just because the returns are good. A good or a bad fund is always relative to your existing portfolio, your goals, what you want to achieve with that portfolio. But the whole I think investor mindset is so focused on that returns part, right? And this is not true just for, you know, mutual funds. The stocks, we do the same thing, right? A great stock becomes a bad stock if it's down 60%.
Yeah.
Overnight, it becomes a bad stock. I mean, what changed? It's the same business, same people managing that company, but suddenly, yeah, no, now it's not a good stock anymore. It's the same thing happens. Same thing happens with asset class. I think Prableen makes another great point there when she says it's not just funds, it's asset classes also. People chase entire asset classes with the same kind of expectation. And I think the part that really kind of, you know, hurts the most is when those expectations are broken. The expectations will be broken. We know that. The data shows that. But by continuously doing this behavior, the investors are actually setting themselves up for disappointment.
Just to follow up, did you by any chance do a study on what happens to the worst performing funds, and do they come up on the top the next year?
We did. I don't know. See, because persistence runs both ways, right? So even if, and this is the reasoning behind it, even if we can say with some conviction that avoid these kind of funds, then at least we have narrowed the choice.
Sure.
Right. So if I can say with some conviction that avoid the bottom 20% of the funds, then come on, okay, you know, instead of 100 funds, now you have 80 funds to look at. I mean, still equally hard, but slightly easier, right? So we look at the worst performing funds, and I think we did that as a 5-year study, which is what we posted. If you look at the 5-year worst performing funds, there's a 15% chance that the next year they will be the best performing fund.
Wow. Okay.
Or in the top decile, they'll move from the worst decile to top decile. So it's a coin toss. I mean, like, seriously.
Wow. So then probably let me put you guys in a talk. Why does any of my viewer why do any of the viewers need this show, need Gaurav, need Prableen or anybody else? I might just go throw a dart and pick a fund because it almost is as likely to be successful as a well-researched strategy, maybe.
Okay.
Sorry, Prableen, go ahead.
Okay, I'll just add something here, Niraj, because in the first question you had asked me, you know, what my experience from the investor returns was, what I've seen. So few of my clients, you know, who had very old portfolios, which I was not even in business then, and they had just shown me, or they moved with us. And I was so surprised to know that, you know, like, okay, a 13% CAGR, which fund is this? Especially in markets when, you know, this year especially, or 11% CAGR is pretty good. And I was so surprised to see the names of those funds, because those names are nowhere in the top performers right now. So it's interesting to see, I think, how the whole dynamic, you know, it's played out of the top performers, because equity as an asset class is meant to move up in a non-linear, you know, manner. and there'll always be different sectors which are picked by fund managers. There'll always be a different portfolio across these schemes, and something will play out in a certain time period. And just this way pharmaceuticals has been, I think it's been an underperformer, and COVID has just made it like the hit of the year kind of a situation. So there have been instances where we've seen the cyclical trends, and that's how the whole pattern of these funds, they underperform, then they are better than the broader markets, and so the phases are there. And to just answer your question on investors should just go out there and buy.
That was just in jest, Prableen. I don't mean it. Come on.
No, I'm quite a believer of broader rules, Niraj. So I feel that you have to take a top-down approach. So you decide how much do you want to put in which asset class. That's the first thing. And because I think we spent way too much time deciding what is the timing of my market, entry and exit point, and which is the scheme. I think way too much time is spent on that. We don't really spend much time on which asset class to buy. So once you've decided which asset class to buy, within that, which product or which instrument do you want to buy? So if you say within equity, I'm not going with direct stocks, I'm going with equity mutual funds. Within equity mutual funds, you decide I need a mid cap, I need a large cap, I need a multi cap, or whatever, or an international fund. And broadly, I think you can just always use these as filters, but you don't have to pick the top performer for sure. I feel it's good to go with a middle order. That's one of my rules. I follow that.
Okay, interesting. The final say on this thing, and then of course we'll move on to the other topic too. But Gaurav, I was asking in jest. Of course, I'm sure there is a reason why people would want, professional help to some extent. And I think the classic example that I give is back until 2018, mid 2018, everybody thought that for debt funds you don't need an advisor. It's just simple. You park the money, you get a fixed return. And suddenly, we know that in the last 24 months, the most important category to analyze has been the debt funds, right? But here's my thing then, Gaurav. If indeed the study shows that it's almost like a coin toss, how does one go out and choose the right fund? Is it a method of what is apt for the portfolio? Is it a method of how does one forecast whether this fund that I'm choosing will give me an X return which might be better than what the benchmark is giving? Is there a way to predict that, or it's almost impossible?
See, predicting which fund is going to outperform is very, very hard, right? Funds have specific purposes, and you have to understand very well why you're buying into a fund, right? Whether you're buying into it for as a speculation or you're buying into it as an investment.
So let's assume it's an investment goal. Let's assume it's an investment goal.
If it's an investment goal, the simplistic way to think about all of this, at least in my mind, is this: do you have an edge to know better than everyone else that this pharma fund will do better, right? So I think what people always conflate is, and especially in sector funds, this is more pronounced. What people always conflate is that first they think that they can choose a better manager. Somehow they have this belief that I can select a better fund manager, which again, the data doesn't show that it's possible. And even when they do that, they will still want to override that decision by saying that I can now make a better sectoral bet or a better thematic bet. Why did you hire that fund manager in the first place then? Isn't it the fund manager's job to place these thematic and place these sectoral bets for you? So from an end investor's perspective, the question boils down to this: how much time do you want to spend doing this? Right? You want to spend 9 hours doing this, then then you're a professional investor. And then you want to build that edge. You want to build an informational edge, or you want to build a behavioral edge where you're doing things which are slightly different than the rest of us. Then be my guest. Have a portfolio that has multiple fund options and churn it, but it's based on some thought process, right? But if you're not a professional management and or a professional investor, then it's always better to have a really simplistic portfolio that serves your needs and actually prevents you from these behavioral biases, because they are going to eat into your returns. I mean, some of the numbers that Prableen said, right? They are based on Indian data, Axis Mutual Funds, it's a 5% behavior gap year on year.
Yeah, that's a sizable one.
Those are pretty powerful numbers.
Yeah, they are. At some point of time in the next 2-3 months, Gaurav, when we do a show together again, I would love to use your website as an example, and I would want to ask you, what should somebody who's logging into Kuvera.in and wants to do direct investments do to choose fund? Let's try and do that in 3 months from now or 2 months from now,
Sure.
just to
I mean, our
see.
answer will be simple. I just use our goal planner and have a recommended portfolio, which is index heavy to begin with. So
Sure, no, but
that's
still,
what we
it will
always
help
say.
because a
But
lot
yeah,
of people are doing this, right?
sure,
If people are actually
sure.
logging in, say, for example, to this show or any other show, and then they're logging into direct platforms, if they're going about selecting the funds with the very basic mistake of just sorting them by the returns, then it's a classic error which they should avoid. But anyways, viewers, we can go on and on with this, but I think we need to move to the other topic too, which is also really important because in a way, it's probably an extension of what we just spoke about, or maybe it is not. It is behavioral bias. And do the returns and do the talk of how global markets are doing so well, is that leading people to invest into international funds? Is that a right strategy? And even if it is, are people are people approaching that in the right fashion? Probably. You have some thoughts here. What have you observed? What is the data suggesting? And are you kind of suggesting this to your clients too?
Right, Dheeraj. So to begin with, I think if we see the current inflows into international funds, we all would just conclude that it's because of the markets doing better than the Indian markets. So I went back and I saw that at how different time periods NFOs were launched in the international equity space in India. So we had the first NFO in 2004. Then we had a lot of NFOs in 2007, 8, and then it was, the global crisis time period 8, 9. And then we had few of them in 11, 12, 14. Till then, we had a lot of these. The maximum number of funds were launched till 2014. 2015, we just had one NFO. And 2016 and 17, we didn't have any NFO in this space, as far as my information goes. And 2018 was the time around, I think, October or November, when Motilal came up with the FOF for their NASDAQ 100 ETF. So that was 2018 end. And then came 2019, which was one fund from, again, a bigger fund house, which is ICICI. They had a Global Advantage Fund. And 2020, we saw two NFOs in this space. Now, if we look at the inflows, the net inflows into this segment, what does that tell us? So I just went through the data for 2017, 18, 19, and 20, the net monthly inflows. So 2017 onwards, it was people moving out of this space month on month. So there was a negative figure starting from the February of 2017 till about April of 2018. May 2018 onwards, the figures were in positive, low figures, and we saw better inflows, but continuously positive inflows from May 2018 through 2019 and 2020. So it would be wrong to conclude that it's just 2020. Of course, the figures have become slightly more robust during this year. But I think, Niraj, it has also a lot to do with the spread of information and awareness. Not every person is aware about geographical diversification and investing internationally. And when these NFOs are launched, which we've seen in this year and in last year, and there is a lot of awareness created by the AMCs around these products. You call them on your shows. There is so much information in print media, and these schemes are discussed. And I think that is one very important point, which probably has struck with a lot of investors who actually feel that, okay, we haven't done that till now. We haven't added an international fund till now. And now I would like to believe that they are able to understand the merit of adding an international fund or, diversifying geographically. And it's not just based on the past returns, and are wanting to do it. And that is why we've seen good numbers, good inflows. So it's really minuscule when you compare with the broader markets. Also, I feel two funds, Parag Parekh. It's been a really talked about fund, but it's not an FOF. It is just investing about, primarily in India. And
35%, yeah.
But again, when such funds are also discussed, how is it that Parag Parekh was holding up in all the other Indian equity funds were, giving returns in negative? Because it has a part of its allocation to the US and other markets. So I think all these discussions just make that point very clear that there is merit, and I'm just hoping that now investors who are entering are coming with the mindset that It is for geographical diversification, because whether it is Indian equities or it is US equities or any other markets, Neeraj, the ground rules don't change. It
Of
is
course, they
equity
don't.
at the end of the day.
They are. And just before I get in Gaurav in this conversation, probably just one quick follow-up. Now, to high net worth individuals who've been around in the equity markets and investing in funds for a long time, geographical diversification is probably a must-do. My question to you is, for people who are new in this game, or people who do not have a very large investment portfolio in funds any which ways, should one start diversifying into global funds from the word go? Or is it something that you advise should happen after a bit of a lag, after testing the waters, and after building some corpus size?
So I feel, Neeraj, that if you're coming to even the Indian equity markets, you have to understand the very nature of how equities work, right? It will always be a non-linear growth. If you
Sure.
understand that, and you understand will hold for any counterpart, even overseas or in the West, till then you are okay with just picking a small, I mean, giving a small allocation of your overall portfolio to an international fund as well, even right from the beginning, till the time you don't consider that that is totally an insulated, part of your portfolio and will never go down or things like that. The basic element remains the same, that its volatility will be there, its equity, the basic nature will not change, be it any market.
Okay. Gaurav, what's your experience been at Kuvera? Has the influx of money to your platform into international funds of various geographies really gone up? And do you reckon, as a behavioral aspect or otherwise, that it's a good thing to do?
Right. So, okay. Is it a good thing to do? So, totally here with what Prableen says, right? I think international diversification is important. It is a currency hedge. And as the country becomes more affluent, there will be a lot of people who would want to send their kids for education abroad or for vacations abroad. So, having some of that expenses already being planned for in that currency is not bad. Is it good? The other big reason is, right? I mean, India is about 3% of MSCI global, right? So as an investor, as an Indian investor, just because you happen to be born in India, for you to have 100% exposure to equity doesn't make any sense. The question that comes is that, what's happening now, is this a serious asset allocation play where people are understanding these concepts, people are understanding that, okay, there is a diversification benefit or is this something which is purely driven by, hey, NASDAQ is up, whatever, 30, 70, 80%, whatever it is in the past 6 to 9 months. And the truth lies somewhere in the middle. I think there are investors who are realizing that there are benefits of international diversification. As Prableen rightly mentioned, there are now also tools available, right? There are low-cost mutual funds. There are direct equity float platforms which are also low-cost that allow you to do that. So even if you have a small portfolio, you can still easily have a 10 to 15% allocation to international equity just by buying that, fund of funds, or buying that ETF, or buying that fund, direct investment fund. And people are getting it. But is it fair? Is it fair to say that that's all that is happening? So see, we disagree a little bit, because what some of the behavior we see on our platform, right? I mean, we have seen flows into international since we started, because our recommended portfolio starting from 2017 had a 13% allocation to an international fund. But what has changed is, in the past 2 months or so, the top 5 most watch-listed funds that most investors are putting into their watch list, that watch list rarely ever had an international fund. In the past 3 months, or in the past 2 months, to be more exact, at least 3 of those 5 funds tend to be international funds. So in a way, discoverability goes up. I mean, even people talk more about sectors and funds that are doing well. Forget returns, right? Say I'm totally oblivious to returns, right? And but I have to still make a decision. So if I hear international again and again and again, if I read about international, if I then even if I don't know the returns, I'll be like, hey, what is this international fund? Yeah, everyone's talking about it. Let me go and check. Then I go and check on a site like ours or someone else. I'm like, dude, the returns are also amazing. Now suddenly what happens is, they are not two different pieces of information you got, but the way you will process it as an individual is as 2 different pieces of information. I heard about the fund, and then I found out the fund also gave good returns. But it could be that you heard about the fund just because it gave good returns, right? So I think both of it is happening. It's only in hindsight that we can be absolutely sure that people are doing it for the proper reasons, for proper asset allocation. But as an asset allocation play, we think you should always have something invested abroad. Whether through Indian mutual funds or direct equity, that's your choice, but you should always do that.
Yeah, just viewers, I mean, just before I ask the final question to Prableen, keep in mind that if you are indeed doing direct equities in the US markets, I mean, doing direct equities in India is difficult. And if you are in an Indian shore and not have the time to study those, maybe, just maybe, leave it to the experts, if you will. And again, the thoughts may vary out here. Different people have different reasons. Keep in mind, both Gaurav and Prableen spend arguably all of their time doing this for a living. And therefore, their expertise on the subject matter would be way different than what your or mine would be. So just keep that at the back of your mind. Prableen, final question to you. We don't usually ask about fund recommendations, but I'm still just wanting to ask you. You mentioned a fund which is an Indian fund, but investing directly into global equities. And there are examples of funds which are also fund of funds, essentially just mirroring a global index. Are you suggesting those kind of funds to people, or are you doing a mix of both?
Okay, so Niraj, within this space, we have a lot of different varieties, like you said. So FOF, where you just buy another fund, or you buy an ETF of a fund which is tracking a broader indice. And we've got different markets as well. We've got funds in India which can give you exposure to Brazil, they can give you exposure to China, they can give you exposure to US, they can even give you a broad exposure to emerging markets. So I feel if somebody has to choose a fund for himself or herself, the first thing is that know what you're going to do. And so let's say if I'm looking to invest abroad and I have to pick between Brazil, China, and America, me and a lot of other people would not even know what is the exchange rate between the currency of Brazil and India, because one Brazilian currency is actually about 13 rupees in India. So it's the other way. We are stronger than them. Likewise, a lot of people would not even know the name of the president or the prime minister in Brazil. So first of all, I think the market that you're wanting to invest in, you have to be, no pun intended, you kind of need to be aware. So it's good to, if I have to put my money, I would go with US, because I think we somewhere track those markets way more. The companies which we know we'll be investing into, we are actually using their products. Right? Whether it is Apple, we use an iPhone, or whether it is Netflix and other products. Secondly, I think American markets are very transparent. The governance standards and regulatory standards for their companies are pretty good. They're robust, and it's 1/4 of the global economy. It is 50% of the global market cap. So, given those, so first to come down to, yes, we invest in America. At least for me, I would choose that. And if I have to invest in US, if I'm a beginner, then I would just, go in for a low expense fund, which is probably an FOF into a broader index there, like S&P 500 or Nasdaq 100. And these two indices also, Niraj, have not performed equally well. Nasdaq 100 is up 30%. Nasdaq Composite is up about 25%. S&P 500 is just about, yesterday I think it's a all-time high, and it's still just up about 5% year to date because of the different compositions, overweight of technology in some and like.
Yeah, on last record and last count, if I'm not wrong, 18th record high for the Nasdaq as of yesterday, and that speaks volumes.
S&P also, I think, I did.
Yeah, S&P hit it, but this was the 18th record high, if I'm not wrong, for the Nasdaq 100. But anyways, we've run completely out of time on this one, but it was lovely having both of you to talk about two very, very interesting and current topics and eye-openers both. So thank you so much, Prableen as well as Gaurav, for joining us today. Safe more Lucknow and Singapore. And viewers, thanks so much for tuning in to this leg of the Mutual Fund Show.
Thanks, Niraj. Thanks.